Now the third method, units of output, is actually the most theoretically accurate of the three, but it's the least often used of the three. Units of output doesn't rely on a fixed period of time, like 5 years or 7 years or 27 and a half years. It relies on a productive life. It says simply that if this piece of equipment is 50% of its life done, it should be 50% depreciated by that date. And I'll give you an example, a copy machine. Yeah, a printing press, but let's use a copy machine because most people are familiar with those. We have this copy machine in this office is rated at 1 million copies. Okay? It's supposed to produce 1 million copies before it craters and gives up. Now, if that copy machine has produced 500,000 copies so far, how much of its life has it used up? Half. And if it's produced 1 million copies, how much of its life has it used up? All of it. Now, one company, it might take 4 years to get to 100,000 or 1 million copies, and another company 10 years to get to 1 million copies, right? Does it stand to reason that the company that uses it more should depreciate it faster then? Yeah. That's right. And so that's the basis of units of output. It first takes the original cost and divides it by the expected output. So if the original cost was $8,000, and it's expected to produce 1 million copies, then that means with every copy we produce, it's going to depreciate by 0.008, or 0.8 of 1 penny. So after it's produced 10 copies, it's in essence depreciated 10 cents, or excuse me, 8 cents. And after it's produced 100 copies, it's depreciated 80 cents, and so forth. You've got to have three things. You've got to have original cost, which comes off of where? The invoice. Then you've got to have an expected productive life. Someone's got to stick their neck out and say, I expect it's going to produce this much. Okay? And that could be copies. It could be hours. It could be gallons. It could be miles. It could be any of those things. Okay? But someone's got to tell you how much it's going to produce. And then it's got to have a meter. Okay? And the copy machine's got all three of those. So it's a good example of where you can use it. Now this means that at the end of each month you need to read that meter, doesn't it? You need to figure out how many copies did we produce that month. And if that month we produced 10,000 copies, then we're going to multiply 10,000 times 0.008, and whatever the product is, that's what we're going to depreciate that month. And the next month we're going to have to go in, and let's say the next month we only produced 8,000 copies. We're going to depreciate that much, and so forth. Administrative, does it make sense to you? Yeah. Administratively, however, it's a mess, isn't it? Okay, remembering to go read that meter every day? Every month? Yeah, every month. This method is used most commonly in major heavy equipment industries like mining and timber. So, could you use it for the semi-trucks? Yeah, you could. Can you use it for the company car? Probably not, because we don't have an expected, life out of those cars. Okay? Now, those are the three methods. In retrospect, then, which one are we going to use the most? Straight line. Let's let the tax accountants worry about double declining balance. If they choose to use it, their emphasis is different, their hat's different, their purpose is different. Units of output is used most often in what industries? Heavy equipment industries like mining and timber. Okay? Other than that, straight line is by far the most commonly used and expected. One other thing I wanted to point out is we talked about building and land, right? If you buy an existing building, that means that you're going to have to figure out what portion of that cost applies to the building and what portion applies to the land, right? Okay? Now, one way to do that is go hire an appraiser. You can pay $400 or $500. It will take about 30 to 60 days, and they will tell you what the value of the land was if the building wasn't there. Then you can the difference will be whatever the building is appraised at. Okay? That's one way to do it. But there's a very simple and expensive way to do it too. And that is to look at the previous year's or the most current property tax records. Now, the property tax records have an assessed valuation on them. Many of you have seen them. If you've owned a home or building, you've seen these things. They come around in October, November, and it shows you the assessed valuation will have one value for the land and one value for the building. And it's never what you paid for it. Okay? It's not the same number. It's assessed in a different way. When we go into a building, we're not looking at just square footage and acreage like they are when they assess it. We're looking at colors, we're looking at layout, and we will pay more for a home or a building that more closely fits our needs. Okay? And if it's well kept. Well, property tax, or the county doesn't have the time and the resources to go out and make those assessments too. So they simply use, it's got this many square feet on this many acres, okay? And that's how they assume it. Well, let's just say that in our example here, we have bought a building with the land, and the land is assessed at $25,000, and the structure is assessed at $75,000. So the total assessed valuation of this building and land is $100,000. Now, we paid $120,000 for that building and land. Okay? We can use this proportionate share to then separate or distribute that $120,000. $25,000 is what fraction of $100,000? 1/4 or 25%, right? So that means the structure is 3/4 of this total, right? Now, what's 1/4 of 120,000? 30,000. And so that means that the structure is $90,000. Okay? And so when we set it up as a fixed asset account, we will have in the building account $90,000, and the land will be $30,000. Do you see that? Now, why do we worry about that? Why does that make a bit of difference? For your depreciation. Why? Land doesn't depreciate. The building does. So we have to know what percentage or what proportion of that $120,000 we're going to depreciate. And that's how we calculate it.